So we have the topic number 7, which is financial statements of a company. And we are beginning by being told that there are two forms of capital in a company. We have what we call the equity capital and what we call the debt capital. So equity capital, it refers to the money put up and owned by the shareholders. And these are the owners of the company. So typically, equity capital consists of two types. There is what we call the contributed capital, which is the money that was initially introduced in the business in exchange for shares of stock or ownership. And number 2, we have retained earnings, which represents profits from past years that have been kept by the company and used to strengthen the fund growth, acquisitions, and expansions. Okay, good. Caroline, good morning.
Good morning,
Karibu sana.
Auntie.
So we have said that equity capital is the money that belongs to the owners. And what happens is that we have the money that the owner brought when you are starting the business. Then with time, as the business makes profits, you are able to retain those profits and they become part of your capital. Then we have what we call debt capital. This type of capital is infused or it is brought into the business with the understanding that it must be paid back at a predetermined future date. So this is money you get from non-owners, outsiders. They bring you the money, but you agree that once you get this money, we shall repay you at this particular date and these particular terms of payment. Now we have what we call issue of shares, is another important aspect that we did not see in the books of a sole proprietor. We also did not see it in the books of partnerships. Now, when a company issues shares, you can issue them to be payable immediately. As in, if the share is worth 20 shillings, if the share is worth 20 shillings, then the person buying pays 20 shillings immediately. So hakuna deni inabaki. The other one is by installments. Installments is where you say our share is worth 20 shillings. But for now, for us to recognize you as an owner, you first of all pay 4 shillings. Then as time goes by and by, we shall be calling. To call means to ask. To call means to ask the shareholders to contribute some more money towards the capital. Now, issue of shares takes place on the following terms, which are connected with the price of shares, the terms. Number 1, you can issue shares at par. Par ni ile face value, ile zimeandikwa. And in this case, shares are issued at a price equal to the nominal. Nominal is the other word for the par, is the other word for the face. Number 2, you can issue them at a premium. Now that means you are issuing them at a higher price. So if the par value is 20 and you want to issue at a premium, maybe you can issue them at 23 shillings. So the plus 3 is the premium. The plus 3 is the premium. You can also issue them at a discount. That is, you give them at a price lower than this 20. And that one is called the discount. And a discount in Kenya, it is illegal. You have to really get a lot of approvals. When you come to the intermediate level next semester to study company law, you'll see that. And they normally say the maximum discount you can give is 10%. So if, assuming you give the maximum, you sell the shares at 18. So you subtract 2. So you can issue shares at par, at a premium, or at a discount. Those are the three possibilities. Now, when you do this, the accounting entries or the recordings of these transactions are done as follows. One, when you issue shares at par, you debit the share application account, and you credit the share capital. Yeah, being the nominal value expected on application. On receipt of the money, when you receive the money, you debit the bank account and you credit the share application. Yeah, so you see now we have opened an account called share application because the share capital account, we will not wish to keep on frocking it with very many entries. It is just like what we saw in the partnership, the capital accounts and the current accounts. So the current is the one where we put very, very many entries, but the capital, we only put goodwill and capital. Now, when you issue at a premium, you debit the share application, you credit the share capital, and you credit the premium. Yeah, you credit the premium because now this increases the share capital. Being the amount expected on issue. Now, on receipt, when you receive the money, you debit the bank, you credit the share application, being the amount received on application. When you issue on discount, again, you debit the share application and you credit the share application. Credit the share application is like inakuanga double entry because of the discount being the amount expected on application. Then that one is a mistake. We are supposed to credit no, it's okay, nimeiona. Nafikiria sijaweka iko hapa chini. Then when you receive the money, you debit the bank, then you debit the discount because discount offered is an expense. So you debit it. And then you credit the share application account. You credit the share application account. Being the amount received on application and the discount. So the next thing is to know the format. This is something that you already know. The format, na tutakuwa tunaitumia sana. Format of the income statement. We always start with the name of the statement and the period. So sasa inapangwa namna hii. We have sales, cost of sales, incomes, other incomes, the expenses, and tunakimbia hivi, tuna less all the expenses, we get the retained profit carried down. Then statement of financial position, hii tumekuwa tukichora. The format is the same like we saw in the books of the sole proprietor and in the books of partnership. So they are basically the same. They're basically the same, except some items that are present in others and absent in others. So that is all about that point. So with that, I want us now to look at a question. That we can be able to handle on the same understanding. A question that we can handle on the same understanding. So let's go to December 2021, question 2. December 2021, question 2. So have you seen the question?
Yeah.
Okay. Let me get my past paper. Kama sikuwa nayo. Tumesema ni December 2021.
Question 2.
Si utusome elea na usisome figures.
Nisome figures.
Usisome figures. Just read the
Okay.
words.
Okay. ZAM Ltd has an authorized capital of 2 million ordinary shares of 20 each. The company's trial balance as at 30th June 2021 was as follows. Purchases. I read the trial balance. Purchases and sales.
You can skip. You can just skip.
Okay. Additional information. 1, the inventory as at 30th June 2021 was valued as 1.2. The second one, the freehold land was revalued to 9 million. Part of the revaluation amount was used for a rights issue of 1 for every 4 shares held at a value of 20 shilling each. As the third one, as at 30th June 2021, insurance paid in advance amounted to 40,000, while salaries and wages outstanding amounted to 6,000 shilling. Okay, the directors proposed a dividend of 10% of the issued shares capital and a transfer of 420 shilling to the general reserve. The fifth one, the corporation tax for the year amounted to 540 shilling. 6, depreciations is provided as follows: motor vehicle and furnitures and fittings. Then allowance of doubtful debts is to be maintained at 5% of the account receivable. Then required statement of profit and loss or loss for the year ended 30th June 2021, and a statement of financial position as at 30th June 2021.
Thank you. Thank you. That's great. So with that, we now seek to prepare the statement as has been mentioned there. So this company is called ZAM Limited. ZAM Limited. Maybe statement itafika mpaka hapa. ZAM Limited. They are preparing income statements. They are calling it what? They are calling it statement of profit or loss. Yeah, let's use that word or that name. Statement of profit or loss. Statement of profit or loss for the year ended 30th of June. For the year ended 30th of June 2021. Have details here or particulars. These figures are in thousands. So these are shillings in thousands. Shillings in thousands. So I told you, you start by doing the framework. And the framework is guided by the general format that we should always have the sales revenue. And what we can see here, we can see that there are sales. The other thing that affects sales is returns inwards. So you check whether there is anywhere we have returns inwards.
Hakuna.
I can't see. So kama hakuna, we then proceed and say less. Opening stock. Then after that, we quickly go to purchases. Now, purchases is also affected by returns outwards.
Mm.
And I cannot see returns outwards. So with that, we will be able to get a figure called closing stock. So that from there, we get a value known as cost of sales. Cost of sales.
We lessing the closing stock? Or-
Yes. Tunaiandika tu hivyo venye nimeandika, tutakuja kuless huko. Is that fine?
Okay.
Yeah. Then the other thing, after we less the cost of sales, we get a figure known as gross profit. Now, gross profit, we now bring other incomes. So other incomes, when you look at this question up there, we can see there is investment income. Investment income. Investment income. I don't see any other investment income mpaka huko kwa additional information. So I can get total other incomes. Total other income.
Mhm.
And that gives us something we call total incomes. Total incomes. Then you bring or you say less expenses. You less expenses. So we need to identify the expenses. So expenses, we can start huko kwa trial balance. Up there, you can see there is administrative. Administrative. That is an expense. We have bad debts written off. Bad debts written off. We come to inventory, hiyo ina shida. We have debenture interest. That's also an expense. Debenture interest. Debenture interest. Investment, that is an asset. We have salaries and wages. Salaries and wages. That is an expense. We have directors and emoluments. Those are the salaries paid to directors. Directors and emoluments. Then we have insurance. That is also an expense.
Mhm.
Insurance. Then we have cash at bank. That's an asset. Motor vehicle, that is an asset. Freehold
Mhm.
asset, furniture asset. Sindio?
Mm.
Then we have
Allowance.
depreciation. So depreciation. Now depreciation is for two. So I have depreciation for the motor vehicles. And I have depreciation for the furniture and fittings. General reserve revenue, those are not part of higher. 12% debentures, the interest iko huko juu, we already have captured it here. Accounts, payables, receivables, those are assets and liability. Ordinary share capital, then allowance for doubtful debts. Allowance for doubtful debt. So that one is an expense. Allowance for doubtful debts. Then we have the inventory, the freehold, the issue of shares. That's not an expense. Information 3 is talking of insurance and salaries. Those are already included here. The directors proposed a dividend. So that will be gotten after we have gotten the profit. Then there is the tax. We have the depreciation. We have captured that. Then allowance for doubtful debts. So with that, we will get a figure that is called profit before tax. Before we get the profit before tax, we need to get a figure called total expenses. We need to get a figure called total expenses so that we less it from the incomes to get profit before tax. Then we less income tax expense. So that we get profit
before tax.
After tax. When we get the profit after tax, we need to see the transfer to general reserve. Transfer to general reserve, we are supposed to less that, because you can see there kuna revenue reserve and general reserve. Then you add revenue reserve. Revenue reserve brought forward. Revenue reserve brought forward. When you get revenue reserve brought forward, then that will give you profit available to shareholders. Then you less the proposed dividends. Sasa hiyo wanalipwa hiyo dividends. And when you get that, you get a figure that we call, either you can call it the retained profits, but this question they are not using that word. They're using the revenue reserve. So we will get the revenue reserve. Revenue reserve carried forward. Carried forward or carried down. Carried down. Carried forward or carried down. So that is the end of our statement. Our statement of profit and loss. Aya. So I think we are good there. And if we are good, now we start recording. Carol, are we together at that point? Carol?
We are together.
Good. Lea, tuko pamoja hapo?
Yeah.
Good. So let's now start the workings. So for the sales, the figure is as given. That is not mentioned. Or maybe we could start by working on, let's start on additional information so that we don't forget anything.
Yeah.
Additional information 1 says the inventory is at that June 2021 was valued at 1240,000. Now that inventory is opening or closing?
It's closing.
It's closing. So tukuja hapa kwa closing stock, we put 1240. Na hii tunajua it will be subtracted. Tunajua that will be subtracted from there so that finally tutakuja tupate closing stock hapa, cost of sales hapa. So hiyo tunaweka hapo. The next item is that freehold was revalued to 940. Part of the revaluation was issued for rights issues. So that one is not affecting us in our income statement. It's not affecting us. Then the next one. The next one is as at 30th June, insurance paid in advance amounted to 400. So if there was insurance paid in advance, you can go up there. You see the insurance is 160. Sindio? So if there is prepayment, we can open an account for the insurance. Insurance expense. Insurance expense. Insurance expense. Insurance expense. So the amount that we can see in the trial balance is the amount that was paid. And when you pay for an expense, you debit that expense account and credit your bank. So what must have happened, we debited here because of the bank. We debited an amount of 160. 160. That is the one in the trial balance. And then we are told that at the end of the day, there was a prepayment. So prepayment is an amount that we have not used. That is an asset. Prepayment is a current asset. So this one will have a debit balance. So balance carried down is 40. And this account must balance. This account must balance with a total of 160 and 160.
60.
So the balancing figure is now the amount that we should take to the P&L of how much?
120.
120. That is the amount that we should take to the P&L. So kuja mahali kuna insurance. Kuja mahali kuna insurance. Maybe we could label these workings. Tunaweza kuja hapa tuseme this is working 1. Working 1, so that tuende mahali kuna insurance, ndio hii, tuseme this was working 1, where we are bringing 120. Working 1, we are bringing 120. Haya.
The directors propose dividend.
Now there is salaries that are outstanding. So this will be an asset in the balance sheet. So we have salaries that are outstanding. So we do the next working. Working 2, salaries and wages. Salaries and wages. Now, for salaries and wages, just like we have argued with insurance, when you pay, you debit the expense account, credit bank. So because of the bank, we have an amount. How much is appearing in the trial balance for salaries?
1640.
1640. That is what was paid. And then we are told there is an amount that is outstanding of 40. So that is an accrual. So it's a liability, and the liability should have a credit balance. So balance carried down is 40. So with that, we should come here and get the total. The total of that, those two, is
1680.
1680. 1680. So the balancing figure is what should go to P&L. That is 1680. So tukuje kwa P&L, mahali kuna salaries, tuseme this is coming from our working 2, 1680. 1680. Next is the directors proposed a dividend of 10% of issued share capital and transfer of 420 to the general reserve. So in that case, the proposed dividends, that now require we have some workings. We have some workings. Because kuna information walikuwa wametaja. So let's come here. We can have working 3. Working 3. We will have, first of all, let's work with the capital. Let's just call it capital. Capital and dividends. Capital and dividends. Capital and dividends. So according to information 3 that we skipped. No, not 3. Information 2. Part B. Inasema part of the revaluation amount was used for a rights issue of 1 for every 4 shares held at a value of 20 shillings. So we need to know current number of shares. The current number of shares. Current number of shares. If you go to where we have the share capital, ordinary share capital, we are told it is 8. Oh, okay. We already know the number of the shares. It is 2 million. So this one does not require working. It's already mentioned there. It's already mentioned. It's already mentioned. So rights issue. So new shares at the rights issue. Rights issue. So they are saying for everyone, or rather for every 4 shares you hold, you get 1. So what will happen is that you take this 2 million that is already there, you divide by 4. Because you are told for every 4. So you do how many 4s are there, you multiply by 1. Ndio tujue how many new shares.
$500,000.
500,000. 500,000. So the proposed dividend so first of all, we get now the issued share capital. issued share capital. This 500,000 times 20.
It's 10 millions.
10 million, eh? Okay. But you see, there is already existing share capital of 8 million.
Hmm?
The ordinary share capital pale tumeambiwa ni 8 million.
Eight. Yeah.
Ordinary share capital. So total issued share capital. So total issued share capital. Total issued share capital should be the existing one, 8 million, plus the new one that we have given.
Hmm. It will be 18.
It will be 18 million. I think there is something that is not adding out well. Let me see. What we should have done is kuna language hapo wanatumia that I had not seen. For every 4 shares held. Naona hiyo shares held and then the shares issued. So the number of shares held. Itabidi turudi hapa to adjust. Itabidi to adjust. Itabidi to adjust. So hii itabidi to adjust. Sikuwa nimeona hiyo that one held. Sikuwa nimeona. So number of shares held. Current number of shares held or issued. Those ones mean the same thing. How you are going to get them, it is, we have 8 million, you divide by 20. Yeah, that's the one we are supposed to use. So make that adjustment. Number of shares held.
$400,000.
400,000. So with that, new shares issued at the rights issue, should be the 400 you divide by 4 times 1. Yeah, that's the way it should be.
$100,000.
100,000. So total shares issued. Total shares issued should be what we had at the beginning, 400,000. You add the new one, we get how many?
500.
500,000. So total share capital, total issued share capital, the total issued share capital is, we have 500,000 shares and each one is valued at 20. Each one is valued at 20 shares.
$500.
We have 10 million, eh?
Yeah.
Then, Carol, are we together?
We are together.
You have a calculator with you?
Yes.
So let's all mute, then you be giving me the figures in the chat. Ndio nihakikishe kila mtu tuko pamoja. Be giving me the figures. So, the proposed dividends now. The proposed dividends. The proposed dividends. We are told it is 10% of the issued share capital. So, Carol, you can mute now. And then you tell me through the chat, you type the figure for the dividend. I'm waiting for that figure.
$1 million.
Okay, 1 million, good. But I want you people now to chat so that nihakikishe kila mtu anatuma their figure. Carol, you know how to chat? Aya. So there I can see the 1 million, good. So that one now, takuja hapa mahali tuliandika proposed dividends. Kuwa wapi? Proposed dividends iko hapa. So hii proposed dividends tutakuja kuiandika hapa. This is working 3 and it is 1 million. Tuiandike hapa 1,000 and it is in brackets that way, so that when we shall less it kuwa hapo. When we less it. Haya. So hiyo tumemaliza working 3. Let us go to the corporation tax for the year amounted to 540. Yeah, that does not have a working. So hata hiyo tutakuja tuiweke hapa. Hapa income tax expense. Taiweka hapa 540. Hapo. That one does not have a working income tax. Depreciation is provided as follows, so that requires a working. So let's draw, or let's have a working for the depreciation. The working for the depreciation. So this is working 4. So this is depreciation. And we can have motor vehicles first. We can start with the motor vehicles. So for the motor vehicles, we have for this year, it is going to be, we are told they are charging 20% of cost. So it is 20% times the cost. Ukienda hapo kwa trial balance, you will find that the vehicle is worth 4,200,000. So 4,200,000. Our figures being in thousands, so multiply that and send me the answer. Yeah, 840. Good. Haya, that 840 tutakuja kuiweka hapa. Hapa hizo ni part of the expenses. Hapa kwa motor vehicle tuweke 840 hapo. Then we need to get the accumulated. We need to get the accumulated. So the accumulated in the trial balance, it is already 1,600. So it will be 1,600 plus 840. 1,600 plus 840. That is how much? Yes, 2440. So this one, we are not recording it anywhere. Now, it will be recorded in our balance sheet. So for now, here we can come and say this was working 4. Then here we go for working 5. So let's change here. Working 5. And this working 5, it is now for the furniture and fittings. Working 5. For the furniture and fittings. Furniture and fittings. Now the depreciation, we are told it is 10% on reducing balance. So if it is reducing balance, you will take the costs of the furniture. Furniture, the cost is 2,600. You less the accumulated depreciation. The accumulated depreciation for furniture is 780. Then, once you get that, you charge 10%. You charge 10%. You charge 10% of that. $182. Good. So that 182 ukuje uandike hapa 182. The accumulated should be 780 plus 182. $780 plus 182. Yeah, 962. I only write when I see both of you have given the same answer. So hiyo itaenda kwa balance sheet later. That will go to the balance sheet later. Haya, hiyo ingine ni provision for doubtful debts is supposed to be maintained at 5% of the accounts receivable. So that requires that we open an account called provision for doubtful debts. So we open an account here, which now will be our working 6. Provision for doubtful debts account. Provision for doubtful debts account. Provision for doubtful debts account. So if you go to the trial balance, you should be able to find it that there was an allowance for doubtful debts. So the balance brought down. The balance brought down is 80. Then this one should be maintained, the closing balance the balance carried down. We are told it should be 5% of the accounts receivable. So it is 5%. Ukienda hapo juu utapata the accounts receivables. The accounts receivable, I think it's 2200. 2200. That will be the balance carried down. So work that out, uniambie ni ngapi? $110. So the balancing figure is increase. So this now should go to the P&L, and this is what we call the increase. The increase. So your increase ni ya ngapi? But that's how we deal with the provision for doubtful debts. If there is an increase, it is debited to the P&L. If there is a decrease, it is on this side, so you credit P&L. And if it is the very first time that provision is created, you will debit P&L and credit here. And first of all, let's come here and say that our provision for doubtful debts, we have gotten it from working 6. It is 30. And when we shall go to our balance sheet, the receivables will be given as this amount here, 2200. And 200, you less this provision for doubtful debts, the balance carried down, this one, we less it. That's the amount that we shall take to our balance sheets. So subtract that, uniambie ni ngapi? $20.90. Haya, so hiyo I think tushaweka kwa our statement. And we are done with additional information. So what now you do from there, unarudi huko juu, you check item per item. The ones that come to the income, you bring them here. And the ones that need to go to the balance sheet, they wait until we draw the balance sheet. So for purchases and sales, those ones belong to the income statement. So sales, we will credit it 10,936 tuanze hapa 10,936. Purchases iko hapa 65 60 65 60. Hiyo ingine administrative expense tukuje tuitafutirie, iko hapa administrative expense, tuiweke hapo. Bad debts written off, hiyo inawekwa hapa. Inventory 1st of July 2020, that is opening. So with that, we can now first of all get the cost of sales. So chukua this 840 plus this minus this. Uniambie cost of sales ni ngapi? $61.60. So hiyo inaandikangwa hapa 61.60 subtracted from the 10,000. Ndio tujue gross profit ni ngapi. $47.76. $47.76. Haya, so turudi tu pale juu, tumemalizana na inventory. Now debenture interest paid. So ukiona wanasema debenture interest paid, that requires a working. So let's go down there, we do another working. So that we confirm whether they paid everything. So working number 7. Working 7. Debenture interest account. So the debenture interest account. So when we pay, we debit the bank and credit. Sorry, we debit the expense and credit bank. So we paid 140. But the amount that we should charge to P&L, the amount that should go to P&L for the year is 12% of the 2,000. Ukiangalia hapo chini, the debentures are 12% of 2,000. So work that out, uniambie 12% of 2,000 is how much? %12 of 2,000 is how much? Yeah, 240. So that means The total here is 240. And the total is 240. So the balance carried down must be 100. Yes, good. So there is a balance carried down of 100. Let me put some more ink in my pen. That means now there is a liability. When we shall go to draw the statement of financial position, there will be a current liability because of that debenture interest. Because of that debenture interest, debenture interest. So meanwhile, hiyo debenture interest tukuja hapa tuseme tumeitoa kwa working 7 na hiyo amount ni 240. Hiyo amount ni 240. Haya, tuteremuke tu tupate investment income of 400. So other incomes, investment income ni 400 hapa. Tuiweke hapo and it's just a loan. So now that iko peke yake, taichorea line below there. Alafu tukuje tuichoree another line here. Ndio tuweke the 400. Now you add this 4776 to this 400. Ndio tujue now the total income that that company enjoyed was how much? $51.76. $51.76. $51.76. Then what next? Investments, those ones will go to the statement of financial position. Salaries and wages, hiyo tulikuwa tumemalizana nayo. Directors emoluments of 240. We had not brought that, so we bring it now. 240. Insurance, tulikuwa tushaleta. Cash at bank, that is a current asset. Motor vehicle, that is a fixed asset. Freehold land at cost, that is a fixed asset. Furniture and fittings, that is a fixed asset to go to the SFP. Accumulated depreciations, those ones will go to SFP. General reserve, the same thing. Revenue reserve, the same. Debenture, we already have addressed the 12%. Accounts, receivables and payables, those will go to the SFP. Share capital, allowance for doubtful debt, we already have dealt with that. So at that juncture, we are able now to add all this. So add all those expenses mpaka hapa. Kuanzia hapa. These ones. You add them and these ones so that nitakuja kuziandika hapa. You add those expenses. That 738. So utaziweka hapa 3738. You subtract them now from these 5176. You subtract from 5176. $14.38. That is the profit before tax. $14.38. Haya, tax tushaweka, so subtract your tax kutoka kwa hiyo 14.38. Naona kama kuna mahali kuna makosa. Hebu angalia ile account tulichora, ile account tuliweka ya salaries. Hii. Hiyo account ya salaries si ilikuwa 1640, alafu the balance carried down. Tuliweka 40 ama 60?
Tuliweka 60.
So kama tuliweka 60 na kulikuwa na 1640, how did we get 1680? Did we say the balancing figure is 1680 ama 1700? Lea kwa hiyo account. Kama tuliweka 60 na tulikuwa tumeanza huko juu na 1640, then change this one, it should have been 1700. Is that so, Lea?
Yeah.
Carol, can you see that? Good. So then adjust here. This then should increase by 20 to be 58. And this one to reduce by 20 to be 18. Yeah. So adjust there. I don't know how we missed that. Yeah. Now give me the income tax, or rather the profit after tax. So you have to revise again now. You get 1418 minus 540. Give me the revised figure. The revised figure. I'm waiting for 1418 minus 540. $878, yes. All right. Then we are told that there was a transfer to revenue reserve, or rather to general reserve, according to information 4, or 420. So 420, we come here, we less it. Then there is the reserve that was brought down, the revenue reserve. And I told you this revenue reserve, it is also what you can call the retained profits. So 1,500, 1,500. So with that, you get to know how much profit belongs to the shareholders. Remember we said capital for the shareholders, ni ile pesa walileta plus the profit they have made. Actually, even this one also belongs to them because reserve bado ni mali ya the shareholders. So 878 minus 420 plus 1,500. Yes, 1958. So 1958, you less this one, you get to report 958. You get to report 958. Get to report 958. Yeah, so that is how you go about it. Any question, Claire? Any question, Carol?
No, I'm okay.
Good. Good. So if we are okay with that, the time remaining is not enough to do the maybe what we could do, we can make another working here so that we recognize these entries, these ones. We recognize those entries. So we have working 8, general reserves account, general reserves account. So for the general reserves, we have the balance brought down. The balance brought down, as you can see it in the trial balance, was an amount of 2,100. 2,100. Then this one, which is a credit, is a debit there, that's why it's negative. So from the P&L, we have brought 420. We have brought 420. So with that, we have the total of 2520. 2520. So the balance carried down is 2520. The balance carried down is 2520. So that is okay. We can now draw an evaluation reserve account. We see what happened to it. Evaluation reserve. That will be working 9. Evaluation reserve account. Now in this revaluation reserve, the balance brought down. The balance brought down, as you can see, there is none. So that account does not have a balance brought down. So tuachane tu nayo hivyo. But we are told that there was a revaluation to 940. So when you revalue, you are supposed to debit the asset account and credit the revaluation account. So who was revalued? It was Freehold. So because of Freehold, we debit the Freehold, then we credit, they are calling it Freehold land. We are told it was revalued to 9.4. So it is 94, and ukiangalia hapo juu, it was worth initially, or the cost of the freehold is 6,400. So that means we must have revalued it up by was revalued upwards by yes, 3,000. It was revalued upwards by 3,000. Then we are told that this amount was issued or was used to issue rights issues. So the ordinary share capital, we are going to revalue it or to change it by, remember we saw that we were issuing out 100 shares. I think we had computed that 100 shares at 20. Now rights issue is like you give them for free. So this is 2,000. And that is the reason why our share capital, if you remember, went to 10,000 from the 8. So then the balance carried down must be 1,000, so that now we report 3,000 here and 3,000 here. That's the revaluation account. The revaluation account. The last account you can draw to complete that credit entry is the working number 10, the freehold land account. The freehold land account. So the balance brought down is 6,400. Then because of the revaluation, we debit here 3,000. So the balance carried down is 9,400. This is 9,400. 9,400. So the freehold land account, that's how it should appear. So we are going to call it a lesson at that point. Then we pick up from there in our next lesson. We pick up from there in our next lesson. Thank you very much.